do you do that in?
Okay, what were you saying?
Can you superimpose?
Wait, so
like
for anybody who just started watching this recording, we haven't even started yet. I'm just pre-class trading. Now, Misha, what was your question?
Can you like put graphs like over each other?
Can I put graphs?
How do you do that here? Yeah, so like to compare them instead of switching like windows, can you?
You mean
Like have it in one window?
To do something like this? Like having two graphs?
Yeah, but okay, where's that again?
Right here on top.
Okay.
You can choose lots and lots of different shapes if you
want.
Okay,
you can sync. Okay, you can sync charts. Okay.
Yeah, you can sync all the charts, and you can have. I mean, you could have. I don't think with a free version you can have 8. I think with a free version the maximum is 4.
Okay.
But let me just put on this trade first. So, how much do I need to buy? And I'll teach you this today, maybe. The spot price is $1.34. My take profit is $1.47. The stop loss is $1.28. I will risk.
How much do you? Oh, sorry. Go ahead.
That's okay. It's 2.32. So the risk percentage is 4.29. 0.0429.
How many things do you calculate for like each of your trade?
I'm sorry?
How many things do you usually, in your with your experience, calculate like on each trade?
How many things did I calculate is your question?
Yeah, because you're doing like math, I assume.
Yeah.
Right?
I'll show you in a minute. Let me just place this trade
Okay.
first. I'm using Bybit right now. But for Bybit, you need to use a VPN. So it's probably going to be pretty slow because I'm trying to do Zoom at the same time.
I might have to go. It's like storming and there's no cellular for some reason. Weird storm in Moscow.
34. 3.
I watched the recording. What? Тут не выйти, тут кошмар. Просто тут ветер такой, ага, дождь, ужас, ужас.
Okay, now I have my trades on for the moment. And let me close this out for a second. Take off VPN. Okay, can you guys still hear me?
Yes.
Yeah?
Yeah, we can hear you.
put in headphones. See if this works. Check, check. Can you hear me?
Yeah,
Loud and clear.
No, I can't hear you. Let me stop sharing.
Wait, you can't.
Hello? Say something.
Something. Can you hear?
Yes,
Hello?
now I can hear you. Okay, good. Okay, so let's get started. We were just doing a little pre-class trading. I put on my 3 trades for today. Got to make sure I keep losing money. God forbid I win a trade. So what we're going to do today, let me share my screen. But hello, Tiffany. Welcome to our trading club. Nice to see you.
Hi.
So, hi. So this is our 4th meeting. Let's review what we did so far briefly. Let's talk about the rules of trading as we do each time. And then I'm going to introduce some important technical analysis today. So to review, we started this whole thing by talking about the horizontal S&R levels. So let's look at, last time we looked at, I think we were looking at Pinterest. Am I spelling it wrong? Oh, pins. Okay, I wouldn't have done that. Okay, so we're looking at Pinterest last time. Ooh, Pinterest is still doing, oh no, it's not. So, Pinterest is still losing money. I don't know what's going on with Pinterest. But we started by talking about our horizontal support and resistance levels. So if you remember, we started by talking about you go to the weekly and you choose your important, here. You go to the weekly and you start making your horizontal lines at levels that seem important to you, you know, and you make sure that you label them. So weekly, you'd always want to label like weekly, 86, 55. You always want to label it with the time frame and the price. And so you would do this. You would do this for any important level. How do we know if a level is quote unquote important? Well, you see if it's a level where price has touched it many times, at least more than a few times. So this is a good example. You have price came up here and it came up and then went down. And then let's look back through the chart. Did it touch this price again? Yeah, it came up and then went down. It came up, it moved around the price, and then it broke through. So this seems to be a pretty important level. Now, when you talk about over here and over here, like these 2 areas, here and here, the price was acting as what we call resistance. And resistance means it was like a ceiling. The price kept trying to bump the ceiling, but couldn't get above it. And then when we got to the next one over here, the price became what we call resistance because it did go through and now the ceiling has become the floor. And now the question is, if the price gets back to this level at some point, will it bounce off like a floor or will it go through and then it becomes the ceiling again? But right now we're trading between this range. This is a big range, $35 to $86. So we want to look for more lines. You know, here went down and back up. So that's a possibly important level. And if you see, we're actually at this level again right now. So again, we always want to label this weekly. That is 54.32. And when you've labeled things, you always pretty much want to lock it. Here's the little lock icon. And then you can't move it. If you don't lock it, then you might accidentally, when you're moving things, you might accidentally move a line. If you want to change it back, you just go to this left arrow with undo. But I definitely want to make sure I lock the line, then it can't be moved, and I always label the line. Things can get pretty messy here. So we want to make sure that we're keeping as organized as possible and we're labeling things. Sorry. Okay, so we have our, this is what I said for our first kind of thing we learned was horizontal S and R, support and resistance levels. And what that means is going on the weekly. You might even want to start on the monthly. And then once you've done that on the weekly, then you go to the daily. And again, now this would be a good level right here because the price went all the way up and then down. This would be another good level. So, and I use different colors. So if I'm having this be a daily level, I will use a different color. And if I'm having this be a daily level, I will use a different color. And I'll make sure to label them and I'll make sure to lock them so I don't accidentally move them. And then we do that on the weekly, we do it on the daily, and then we do it on the, and you can always get these things, all the time frames here. If you put a star on the right, then it'll appear on the top of your screen, which I do. So then you go to 4 hour and you do it on 4 hour because 4 hour you might get other levels. Like maybe this was a level on the 4 hour. Here's a good level. It went up and then down. When we get to these high places, that's usually a good, and I use a different color and I make sure to lock it. And we always want to label it. That would be 4 hour, 75, 23. So that was pretty much what we did first on our charts. That's the absolute first thing you need to do. Because if you don't do this, you are chasing a trade. And you never want to be chasing a trade. You want the trade to come to you, right? It's like chasing a cat. You can't chase a cat. You'll never catch it. But you want the cat to come to you. So you have to make these lines are your little bowls of milk. And the cat is going to come to you. And if you were prepared right here, if you knew that this was an important line because you drew it all the way back here, and then you saw price was coming close to your important line, now at this line, you need to make a decision. And that's what we're going to talk about today. How do you make the decision to know, is it going to keep going down or is it going to reverse direction? That's the whole key to trading, is having these important lines and then being able to determine at the line, is it going to keep going down or is it going to reverse direction? And then I asked you to make charts on your own for homework, so I'll look at those in a minute. The other thing, the second thing we talked about was, I'd say trend lines were really the second thing we talked about. So for a trend line, now trend lines, again, are a little more art than science. What you're going to do is you're going to go to trend line. That's on the top. And you can choose, obviously, whatever color you want. So for trend line, you're going to connect the bottoms. Now, let's say I drew the trend line here, and this looked like a good line. It touched it once. It came back and touched it again. It came back and touched it again. Now, my thought would be, as long as the price stays above this trend line, we're good. Now, maybe you don't want to use a line. Maybe you want it to extend forever. If that's what you want, instead of using a line, you use what's called a ray. An array will connect 2 points forever. Again, you could use, if you wanted a straight line, you could use a dashed line. You have lots of choices, or a dotted line. For rays, I usually use a dotted line. In colors, you can use whatever color you want. So let's say this was, I prefer a line, actually, a trend line. So let's go back to trend line. Let's say this was my trend line. But then the price came down and it didn't touch it. Well, okay, maybe I'm going to now adjust my trend line, or maybe I'll even draw a new one that looks like this. because I'm drawing it off of this bottom and then this bottom over here. So let's get rid of this one now. Here's our trend line. Now here's a pretty good example. It touched it here. It came down and touched it here. It came down and touched it here. And here would be our question. Just like, so this is, you know, the lines we did first are horizontal. That's first. Second is diagonal, but it's the same idea. Is this a floor or is this a ceiling? It's the same idea. So we come down to the floor. Well, we want to know, is it going to go back up or is it going to break through and the floor becomes a ceiling? And it broke through. Now, the question is, how do we know that? The next thing that we talked about looking at is M's and W's and how they confirm. And that's very, very important. So when M, as I said before, and M is an indication that price is going to go down. It's not pretty. Let me use the polyline tool. That's prettier. So like let's say a W first. A W is whether it's going to go up, and it would look like this. The way you know it's a good W is that, where's my arrow? Here it is. The price on the bottom is going up. That's a W. And M is the opposite. Where the price, looking at the top, is going down. Those are M's and W's, and that's the next thing we need to look for. Except it's not enough to just find an M or a W. You have to have it confirm. And confirm means that at the middle point, like here, the middle point, that at the middle point, the price will cross this line. Sometimes the price goes down, the price goes up, the price goes down, and then the price just moves around here. That's not a good W. It needs to cross this middle line, this C, the tip of the W or the tip of the M. It needs to go down below. So let's find a W or an M on Pinterest. This one's not beautiful, but here is a W. It goes down, it goes up, it goes down, and it goes up. Now, does this confirm? Get rid of these. Where does this price confirm? It confirms at this point right here. Make that color easier to see, okay? So it would make that a little easier to see. Look at a dashed line there. It confirms, as you can see, right here. And because the price went down, up, down, and then it went past this middle line, the C point, this is A, B, C, because it went past the C point and kept going, we had reason to believe the price would keep going up, and it did. Let's look for an M.
I have a question.
Yes.
Can you go back to that W once again?
Yes.
And can you zoom in that circle point? When you see there, like actually that crossing the point, the price is going down. This is not a like dramatic example, but like if the when the price goes up, no, when the confirm points,
So I think I understand your question.
yeah,
And it's a good question. And the question is, what if it confirms this point, but it confirms it with a red candle?
yes,
So
yes,
what if it touches this point, but the price looks like it's going down? And that's a good question. If that happens, don't do anything. Wait until it confirms with a green candle. So I would not buy in actually until this point right here. Where this green candle closed, that's where I would buy. I wouldn't buy on the red candle because like you said, you don't know if the red candle is going to keep going down. And right now, we're looking at a 4-hour chart. By the way, Tiffany, since it's your first time, if you have questions, feel free to just ask. So we're looking at a 4-hour chart. So each candle is 4 hour. What if we looked at a 6-minute chart? Now let's find that line, that circle. Where's our circle now? On a 6-minute chart, you know, the thing is, if you look at a 4-hour chart, look how tiny this circle is on a 4-hour chart. It's just it's one red thing down and one green thing up. But the thing is, when you go to a 6-minute or 12-minute or whatever, everything changes. It looks so much bigger. And in fact, it's not just that it looks bigger. Look at all of the action that is happening in the space of that one red candle. If we really zoom in. I mean, look at all the things that are happening between that one red candle. It's no longer one red candle on a 6-minute. It goes all the way down and you don't know, it broke the trend line and you don't know if it's going to keep going down. I would not buy at this point, even though that's the like buy low, sell high. Of course, that's the low. But if you take that risk, there's a chance it keeps going down. I would have bought at this green candle here. When this closed, and you'd still get in at a very good point. So then it shoots up and then you see it stays above the trend line. And then it goes below, oh no, but then it shoots back up above. It goes below, oh no, and then it shoots back up. It touches it, it goes 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 back up. So, you know, the trend line is being respected here, but you never want to buy the red candle. So that's kind of what we did so far. Those were the big 3 things we did. The horizontal levels, where you'd label them on the weekly, daily, and 4-hour. The trend lines, where you would connect the bottoms, not the tops. You connect the bottoms of the candles to give us a diagonal floor and ceiling. And then the M's and W's, so we have an idea of, is this thing going up or going down, the confirmed M's and W's. And another way to say that is we're looking at the trend. Is the trend going up or is the trend going down? Those are the 3 things we learned so far. Any questions on those? Anybody have a chart they want to show us about M's and W's or S&R lines or anything?
I have new one.
Okay, so let me give you the power to share. Okay, you should be able to share now.
This week I did Apple.
Okay, those looks like some nice W's.
Yeah.
Good, you have your weekly and daily levels marked, so you know.
I tried to go to 4 hours, like more short period of time, but like I was getting a little bit confused, and I think I marked pretty much like those big lines in weeklies and dailies.
Yeah, the
So,
4-hour can get really messy.
yes, so I didn't actually go through it. So I found this 1W looks nice, and then there's another W that confirmed and it went up. Like
Yeah.
this is, so I just put it in like that.
I agree. If you were trading those W's, now the only other thing would be to watch the levels. So the B point of the first W, where it went down, B, that's
This
C.
one.
No?
This one.
Yes, that's the B point, right? A, B, C, D, E. So the B point, as you can see, that is textbook. That absolutely touched your weekly level. And at that point, we would want to know exactly what we're going to do today to figure out, is it going to go up or is it going to go down? But that is an absolutely textbook level. So then it goes up, and then it goes to the C point, it then D point, then it confirms past that. Now, if you see up to the E point, that's another weekly level. So again, you know, now it's just really, Apple is really respecting these levels, and that makes sense. Now, why does it make sense that Apple respects these weekly and daily levels? Here's what I was taught. And I'm going to talk about this more next week. And this gets a little bit, I almost want to say spiritual, but you know, there are millions of people who invest in Apple. Millions, you know, hundreds of thousands at least, but probably millions who invest in Apple. And all of these people, most of them, have learned the things I'm teaching you. And if you watch videos, you'd learn this. And if you took a course, you would learn this. It's all pretty much the same thing. So you have millions of people who are drawing these lines on their chart and deciding what to do when it gets to that level. Because of that, Apple respects the levels. When it gets to a weekly level, you have millions of people who are all watching it at that point. And if you have a million different people who say, oh my God, it's getting to this level, and the indicator says it'll go down, they're all going to sell. Then you have millions of people selling, of course the price goes down. Where's everybody else? I see Minsu, your screen. Can everybody else hear us or see us?
Hi.
Oh, it's my view. I had the view on speaker only.
Yeah.
Okay, that was my problem.
I was for the now I'm back.
Okay.
I was going to ask how. Hear me?
Yeah.
How far should you make lines, like the weekly levels? Like you wouldn't get Apple data from like 2010, right? So how far do you go with lines?
It's up to you. I mean, yeah, if Apple right now is trading at, you know, $150, there's no reason to be drawing levels at $1. I mean, yeah, Apple way back in history traded at $1. Was that your question? Should you go back to the beginning of time for this asset? Yeah, I don't. When I'm making levels for Bitcoin, Bitcoin's never going to be $9 again. I don't bother. And if it did get down there, then I'll go make the levels then. So I keep the levels pretty contemporary, somewhere within, you know, the range, a couple, you know, where thousands of dollars or hundreds of dollars. As you see, Minsu did it down here to Apple at, you know, $40. Hey, I don't think Apple's going to go down to $40, but it's great to have those levels on the chart because it shows you what levels are being respected, what levels are important because they keep getting touched. And that's important because not every asset respects levels as much. Apple happens to be such a highly traded asset that you get what my teacher would say. My teacher would say that if you put a million people together, they become a living organism. They become like a flower or a tree. Like all of the cells in your body create one body. 1 million and 10 million people trading Apple become one sort of organism, a homunculus, if you will, to use a word probably you don't know. It becomes sort of a creature, and that creature makes decisions based on the laws of nature. And we'll get to the laws of nature next time when we talk about Fibonacci. But for now, let's stick with, there's a couple more things we need to know before we get there. But these W's look great. They're respecting the levels. And you can see right at the end of the last W at the E point, go to the E of the last W, the higher point, right around there. You see the price is respecting that weekly level at 145. It just keeps bouncing off that 145 level. And now we're in a range between 145 and 150. You know, and now the question would be, okay, is it going to go up past 150 or back down? And if it goes back down, now 145 is our floor. If it breaks through 145, then 137 is our next floor. And that's it. We have these ceilings and floors. And so that's great. Thank you. The next thing to check is, how do we know if things are breaking through? That's what I wanted to talk about today. Any other questions on this chart?
No.
Okay.
No. Actually, wait.
I do
This is
not
not
like that. That's not an M,
Okay. Okay.
because your D point is higher than your B point.
Yeah, I was just confused, so I just did.
Now that second one, the little one, the baby M, that's a baby M, yes. And you can see when it confirmed, then the price continued going down.
Mm-hmm.
And that baby W is a W2. Those are good. Now there's one thing though I should say. Look at the baby W right there. Look at the B point.
Yeah.
That's not a great B point. As my teacher used to say, we like wide bottoms. We like big bottoms. You know, we like a little junk in the trunk, little booty. We like a big wide bottom. This is a little sharp. It came down, it came up. Now go back and look at the baby W. Look at the B point of the baby M, the previous one. Look at the B point. Yeah, now that B point is a little better, because at least you have like maybe 1, 2, 3, 4, 5 candles that kind of form the top. But when you only have one candle that goes up and then one down or something like that, that's not a great B or C or D. We don't want it to be so sharp. We like it to be sort of up and downy. Okay, so please unshare. Thank you. And I'll go back to sharing. Okay, so rules of trading that we've covered so far. Never risk more than 5% of capital on any single trade. I break this rule all the time, but when I break this rule, I usually lose money, and it sucks. So if you're trading with $100, $5 on a trade. And I said last time, you have two choices here, right? If you're trading with $100, so if your capital is $100, then you have two choices. Choice number one, you could trade $5 on any single trade. Now, what happens if so I buy $5 of some cheap stock, or some cheap coin. Well, if it goes to zero, I lost my $5. That's fine. But there's another option, is you could trade a bigger amount with a stop loss. And that's what I think most people do. So an example of that would be, let's say you buy $100 of a stock and sell when price goes to 95. Does that make sense? Because that's a pretty important idea. That there's two ways to do this 5% of capital rule. Anais, does that make sense to you?
It does.
Okay, good.
We talked about it earlier.
I'm sorry?
I just mean that we talked about it in previous classes before.
Yeah. So it's a really important rule to me. Okay, then you want to always preserve your capital, establish an edge. That'll take time. Trading should be boring. You need 3 unrelated reasons to take a trade, right? One reason, like there was a W, that's not enough. Now, if you have a support and resistance level and it's touching that, and it's a W, and you have another reason, which we'll talk about today, then okay, but you cannot take a trade for one reason. I took 5 trades yesterday, all for one reason, and I lost every trade, and it was terrible. You know, it's okay. It's like fighting someone and just getting hit in the face over and over. Location is the most important thing. That's number one. When I say location, I mean those S&R levels. Another bus in 10 minutes. You can always, if you miss a trade, do not chase it. Never chase the trade up or chase the trade down. Wait for it to come to you. And here's a new rule. Always journal your trades and your thoughts or feelings. So let me show you how to journal your trades. And I'll send this to you guys on the chat. But here's an example that I'm going to give you of an equities trade log. That this is like what I use. Equity means stock. So this is for stock. I use a different one for crypto, but it's all the same idea. And then I'll send it to you. And I put 2 examples on. So here's my log, and you have to keep your trades written down and organized. So here would be, I would call this like finish trades. And I probably have another one for current trades. So here's the ticker, like IBM, you know, or Apple is APPL. You need the ticker. Then I have the name of the stock, the purchase date. Some people do the purchase time. That might be important to see your own patterns. Are you making good trades at midnight and bad trades at 3 a.m.? You know, it's good to see that. The amount purchased. So I purchased 35 shares of this company, Leaf. The amount sold, because that was later I sold it. I could move that. Let me move that now. Cut that. Let's. Move that there. Amount sold. Let's move close date. I mean, I change these things all the time. You know, I definitely play with them. So, okay, I bought 35. Here's my open price. You know, that's your entry price. Then move this also, cut this amount sold here. Okay, so I bought it at this price. I did not have a stop loss or a take profit, which is stupid. And I sold 35 at this price on this date. So this took a little less than a month from May 10th to June 3rd, and I won $72. Now, my total money collected was not that much because there are fees when you're trading. Oh no, this was the money I spent. This is the money I collected. And then for profit and loss, it's very simple. If you look at the equation here, it's this minus this. Now there's more things. Sorry?
What's R/R?
Risk and return. So if we're doing, let's get rid of this. This is terrible. Let's go to the front of this. Okay, let's say I think this is a good price and I want to buy some now. I go to here. This is my long position. So I'm going to buy it at this price, okay? And let's say I think a good take profit is, let's say this is an important level because it's clearly respected this. So that's going to be my level. And I'll put my stop loss below the last kind of wick. So a wick down here, I put it a little below, I'll put it here. So I'm buying at, what's my buy price? $54.85. My stop loss over here is like 54. Let's make it 54.10. What's my risk to return? 2.85. For every dollar I risk, I could get $2.85 back. That's my risk to return. So you see over here for risk to return, like, oh, this shouldn't be a dollar amount actually. This should just be a number, 3.94. This one, I wasn't careful on it, and I didn't write them down. I had it, I just didn't write them down. Sometimes I'm lazy, but I had a good risk to return here, but I still lost. And that happens. Now, how do you calculate? So here's the deal. And I'm going to teach you something now that I wasn't going to show today, but it's actually really important. So let me just show it. If I put in $1, let's say I buy 1 share of Pinterest, it costs $54. If it goes up to here, it's worth $57, right? So if I buy 1 share here at this buy price, and I sell it at my take profit, how much money have I made approximately?
So like, okay, so you'd make like $3
Yeah,
If-
right?
plus.
If
but
I
isn't-
buy
like-
1 share at, let's say, 54, and I sell that share at 57, I have made $3. Now, would you say that is a good deal? You're risking $50 because the price could crash. You're risking $50 to make $3. Is that a good deal? No, it's a terrible deal, right? So this 2.85, that's what I want. I want 2.85 returns. So if I risk $1, I get $2.85 back. That's what I want. To do that, I can't buy 1 share. I have to buy more. Now, you're not going to be able to do this at the beginning unless you started with a lot of money. But let me show you how to figure it out. There's a couple of things you need to know. Okay, here's what you need to know. And this took me so long to understand, but hopefully I can explain it to you better. How much money do you want to risk on this trade? Let's say, how much are you willing to lose? Anais, let's play with you for now. How much money are you willing to lose on this trade?
Uh,
What would be an amount that if you lost it today, you'd be like, damn, but it wouldn't really mess up your life or anything. It'd be okay.
okay, $25,
Okay, you're too rich for my blood. Let's say 20.
$20.
If I lost $20 today, I'd be pissed off, but it's like getting punched in the face, but I wouldn't be knocked out. I could come back and fight again. And the good thing about 20 is if we win, remember it's 2.85. What's 20 times 2.85? $57. How would you like to have $57 today? That'd be nice. So we have our risk. And part of it is how much you're willing to lose today. That's the biggest issue, but part of that determines how much you'll make. Then we have spot. Spot means the entry price. So our entry price will be $54. We have to know our take profit, usually written as TP. What's our take profit price here? We said it was 57. How do you know the take profit price? Use one of your support and resistance lines. That's how you know. We have to know our stop loss. Do not take a trade, despite the fact that I do it sometimes without a stop loss. What is your good stop loss? Just put it a little bit below. Just put it a little bit below the last low. Unless you have a good level, you could put it at this weekly if you wanted. I mean, that's a nice stop loss level if you wanted. But then we have below 2, and I don't like to trade below 2. So I'm going to put it up here. Let's put it at, let's make it 54, pick a nice number. How about 54.10 or 54.10? Okay. Let's go back. So our stop loss will be, let's say, within our entry, let's make it 53 will be our stop loss. Okay, so we know these three. Let's adjust this now so it's right. Our entry price will be 54. Our take profit will be 57. $54. Oh, you can't make it below what it is now. Okay, 54.10, 57. And let's make our stop loss 53. Let's adjust that. Oh, wow. That's even below here. I don't want that below. Okay, we're now below the current price. What's the current price for this? 54.10. That's the price it's trading at. Let's buy it a little higher then. Let's buy it at 54.32. Okay, so let's buy it. Well, let's just make this easier. Let's just say we're going to buy it at 55. Our take profit is 57. Okay, these numbers should be a little easier. Now, here's the next thing you need to know. How much money do you need to spend to make this trade work? Okay, and here's the math you saw me doing before. The calculation is the risk divided by the percentage risk. So our risk here is $20 divided by what's our percentage risk? That's where you need these numbers for. Your percentage risk is this red number in the parentheses. So let's change these numbers to be correct. Entry price is now going to be 55. Our take profit is 57. Our stop loss is 53. Okay, so here's where we are. Boy, I don't like this. 753. I got to move this up. 53.59. 53.59. Okay. Now we have, it's still not good enough. I won't take a trade below 2. Okay. 54.19. Okay. So let's change this. Our stop loss is 54.19. Okay. So what's our percentage risk here? 1.47. In decimals, of course, 0.0147. What is that? That's the math I was doing before. 20 divided by 0.0147. This is how much money you need to spend. Now, you're not spending it, you'll get it back. You're risking $20. You cannot lose more than $20. But to make this trade work, that's how much money you need to buy. So the next is, how many shares do you need to buy to make this trade work? And the calculation is money you need to spend divided by share price. So we just figured out the money we needed to spend was 1,360.5 divided by the share price of Pinterest. Let's say that's current share price is, it's 54.82, I think, 54.82. $24.8, so let's say 25. To make this trade work, you need to buy 25 shares. Now, how do you know if this trade is going to work? Because if you buy 25 shares at the take profit price, you will sell 25 shares times the take profit price, that's 57. What's 25 times 57? 1425. So that's 1425. How much money did you originally spend on this trade? 1360.5. So how much money did you make? $64.5. At your take profit price, you will have made a profit of 64.5. What about at the stop loss price? How much money will you lose? You will be selling 25 shares times your stop loss price, that was 54.19. Equals 1354.75. How much did we originally spend? 1360.5. Well, that's almost nothing. You will have lost $5.75. Is this right? That can't quite be right. I must have my prices wrong. The stop loss price, entry price. If my entry is, let me adjust this. My entry is 55. My take profit is 57. My stop loss is 54.19. Yeah, I mean, if you have a stop loss that's this small, you're risking $5 to make $64. That's not a bad deal. You know, that's how we make money. But the deal is, to do this trade, you needed over $1,000. Now, you're not risking that, you're risking $20. But, is that right? 1.47, 1560. Something is wrong here. Um, 54.82. Oh, yeah, that's what's wrong. I'm not sure. Either way, that's the math that I was doing before, is just the risk divided by the percentage risk to see how much money I needed to spend. And remember, that's not how much money you're risking. That's just the amount of money you need to spend to make this trade work. And then that tells you how many shares you need to buy. So what I'll do, just so you have it, is I'll take a photograph. In TradingView, you can always click on the photograph and that takes a snapshot. I want to save the chart. I want to copy a link to the chart image. Copy the chart image. Is that what I want? Save to the clipboard, or I could save the chart image. Okay, that's saving it. I just want to copy the link. Okay, how can I send it to you? You need to unshare and chat. Yeah. Okay, yeah, that's the link of that math that we just did. Also, I wanted to send you the equities trade log. I need to close it. Yeah. Okay, so I sent you those two things. And I usually also believe in keeping a journal of like what you did and, you know, how you felt about your trades today and stuff like that. It's really good over time for patterns. So there's two more things I wanted to show today. We're doing okay on time. One thing, let's go to a new chart. I want to look at Apple. What should we look at? Any stocks anybody wants to look at?
The one you were looking at earlier, Leaf, was that a cannabis company?
Oh, maybe. Let's see. I have under marijuana. A-Leaf. Well, if you want to know what a company does, here's how you figure it out. There's a couple ways. Here's the easiest. Yahoo Finance. Yahoo Finance is actually pretty amazing. It's the thing Yahoo does best. So you search for anything. And it'll give you all this financial information about it. It'll tell you the earnings, lots of news stories about it. And here on the right, it'll tell you just generally what they do. They do mobile games. No, you want a cannabis stock. Let's look.
That's the one I've been doing my homework with.
Which one?
ACB.
Oh, ACB. First on my chart. What's going on with ACB?
Sure. Can you try like typing it?
Yeah, I will. Maybe they changed their name or something. That's Aurora Cannabis. Okay, here it is. Okay. So we're on the daily chart so we can get a good big picture of this. Okay. Here's a nice W, and it confirmed right over here, and then price shot up. Here's an M over here, it confirmed, price went down. This is nothing. This is an M, it confirmed, price went down. So it's respecting the M's and W's. This looks like a pretty important level right here, whatever this is. Daily. Looks like a pretty important level. So, okay, I mean, that's good. It tells us, because that's what I want. We're at an important level. It's gone up, it's gone down, it's gone up, it's gone down. But obviously this level is important. And the next two things I wanted to show you. We have these support and resistance lines. We have our trend lines. You know, here was a trend line that it was respecting. You know, here was another trend line. Remember, draw them from the bottom, that it was respecting. So we have our trend lines, we have our support and resistance lines, we have our M's and W's. Next, there's one more kind of support and resistance we have to understand, and that's moving averages. So a moving average is, I wrote it down, we're going to talk about SMA and EMA, and then we'll talk about MACD. That's what we're going to do right now. An SMA is a simple moving average. So a simple moving average, it takes the price of the last few days or whatever you want. Let's say I want to make, here I'll add one. Let's go to the function. Let me type in moving average. Add that to my chart. Okay, let's get rid of these trend lines for the minute. Now here's a moving average. This is a simple moving average, and if you go to the gear icon, we'll see that this is a 9. It's the same as chart, so we're on day. This right now is a 9-day moving average. What that means is this is the average of the prices over the last 9 days. You know, how do you get that math? Well, it's very easy. You look back at the last 9 days. If the price closed at, what's the price here? $6. If it was $6, $7, $8, $9, $10, $8, $10, you just add all the last 9 days together and divide by 9. And that's the average. Now, how does this help us? Well, look at what happens when the price is below this average. So over here, for example, the price is below the moving average. This is acting like a ceiling. It is acting like resistance. Price tries to go over it, it can't, goes down. Tries to go over it, it can't, goes down. Tries to go over it, it can't, goes down. It's acting as resistance. It's another support and resistance. The difference is this one is dynamic. It's not static. It's not fixed. Now, what happens when price goes over the moving average? It bounces off, tries to break through. It can't. It bounces off. Then it goes through. Then it goes through. So you can make this any number you want. And different people like different numbers. The most famous and most important numbers are, this is the 50-day moving average, or what's called the SMA 50 or 50 SMA. Now, I made it in green. You can do whatever you want, but this is 50. And it's the same as the chart. So what that means is if I change this chart to a 1 hour chart, now it's not 50 days, it's 50 hours. If I change it to 1 minute, now it's not 50 hours, it's 50 minutes. But let's keep it a day for right now. And let's look at this line. You see what happens when the price is below the 50? It's going to try to break through. And when it breaks through, that's a pretty good symbol for us that it's going higher. When it breaks below the 50, it's a pretty good symbol that it's going lower. It broke above, it went higher. Then it touched it, now it broke below. So what would we be waiting for? We'd be waiting for it to break above. But what people usually do with moving averages is they use more than one. And the most famous combination is the 50-day, which is this, and the 200-day, which is this in red. Let me make that white so it's easier to see. Okay, this is the 200 moving average. So look at where the price was in the last 200 days. The price was around $83 here. But look at the real price, it was at 40. It's way below the 200-day moving average. What that tells us is it is bearish. Bullish means it's going up. Bearish means it's going down. If it's below the 200, things are looking a little bad for this stock. If it's above the 200, things are looking good. Now, here's the big magic. What happens when the 50 crosses the 200? Here, the 50 crosses above the 200. Here, the 50 crosses below the 200. This is the golden cross, and this is the death cross. When you see a golden cross, 50 crossing above 200 SMA, that means buy. That means price is going up. When you see the 50 going below the 200, that means sell. That means price is going to crash. Now, what you can also do is turn on an indicator that's called, it's free, called golden cross. And that will put these lines every place that there's a cross. So in that sense, you don't even have to, if you don't like the averages, you don't even have to have them on your chart. This golden cross will tell you, I like to look at the lines, but you don't have to. And it'll tell you every place. So here was a death cross. It would have been a great time to sell. Now, if you were just looking at these two lines, the 50 SMA and the 200 SMA, you would have made an excellent trade right here because you would have bought. How do you know when to get out of this trade? Right here, you get out. And then you short the stock, you would have made a lot of money. And then here, you would have bought. and you would have stayed in here, you would have broken even, you know, and then you get out. But this is a big thing people look for. Now, in addition to the golden cross, which is 50 crosses above 200 SMA, and the death cross, which is 50 crosses below 200 SMA, there's also something called EMA. So SMA is a simple moving average. It's just the price of every day, 200 days, 50 days, divided by 200 or divided by 50. You could do that math yourself. EMA is harder to do the math. Let me get rid of this and let me put on an EMA.
Can you show me again how to open those indicator?
Sure. Get rid of these. You go to this FX on top. And when you click the FX, you have the built-in scripts. All of these are built into TradingView. These are all the most important the most important indicators. And we, in the next weeks, will talk about stochastic RSI. We'll talk about relative volatility. We'll talk about price oscillators. OBV is important. Moving average is what we're talking about today. Lots of these are important. And we'll talk about different ones. We can't even talk about them until you know your SNR levels. That has to come first. Because, you got to wait for the price to come to you. And then all of these indicators help us determine if the price is going to go up or down at that point. Then there's also the public library. These are ones that are made by different people, like Lazy Bear makes a lot of them, and you can see how many likes they got. So scripts that have a lot of likes are, and there's, God knows how many of these, there's just sort of like a huge number of these. But the scripts that have the most likes are obviously scripts that people like to use, or indicators that people like to use. I don't play with these too much because I'm still learning. I've only been doing this for like 3 years. I think I'm not ready for a lot of these. Then there's volume profile, which I said you need to pay for. So you guys can't use this yet, so I'm not teaching it to you. But I use volume profile. And there are ways to get it in the public library, like if you search for volume profile, let's see. I mean, there's tons of them. You would have to see which one you like. Let's see what this one looks like. See. Any good? No. No, I don't even know what that's doing. Volume profile? Don't even know what that's doing. Yeah. So, yeah, you just go to the FX on top. So let's now add an EMA, and let's talk about what that is, EMA. That's called moving average exponential. So what we just did was the SMA is just known as moving average. It's just moving average. We'll start there. Now let's talk about moving average exponential and add one of those. Now we have an EMA. See what this is. This is an EMA 55. Okay. Now let's change that to 21. Okay. Now this 21 EMA, it's not the same as SMA. And I can't explain the math to you because this math is beyond me. But what they do with the EMA, the exponential moving average, is that right now it's 21. So if it was SMA 21, let's turn on an SMA 21. Let's make this a 21. They're very close. The white is the SMA. So the white SMA is the last 21 days prices added together divided by 21. That you could figure out on your own. I get that math. The EMA is weighted, which means the more recent days have more weight than the previous days. So if there's the last 21 days, day 1 to 21 days ago, those have less weight. And the yesterday and the day before have more weight. So you see the green line hugs the price much closer. It's bigger. As you can see, the green line hugs the price a little bit closer. The white is a little bit farther away. The green is a little bit closer. Now this green 21, that's what I usually use as an indication. For me, trading below, oh, I have 200. The 21 and the 200 are the two that I'm using right now. So let me put on a 200 EMA also.
David, but
Yeah.
these lines, do they predict anything, or do they stop where the trading data stops?
What do you mean stop where the trading view stops?
I mean, like where the latest information is. Like, I mean, it's like, what kind of information can you really get from that apart from like what the price has been?
Okay, so what it can tell you is whether right now the direction that price is moving is up or down. Just like generally speaking, is the price going up or going down? That's the key to these lines. So when it's above, the white is the 200 EMA. When price is above this, generally price is in an uptrend. When price is below this, price is generally in a downtrend. You know, when price is above the 21 EMA, I expect it to drop back down. Price is above, I expect it to drop back down. Price is above, I expect it to drop back down because I expect it to stay close. So when price crossed the 21 EMA, let's say it's above the 200. So I would have bought here, for example, but when it got high, I would have sold because I don't think price is ever going to get too far away from the 21 EMA. It's always going to stay close. But here, look how far away price is from the 200. That means, you know, you're getting farther and farther away. The price is in an uptrend.
David, I have a question.
Yeah.
Can you draw W's and M's with those lines?
Yes, you can draw W's and M's with anything. You're not going to be able to very often though, because the whole point of these lines is they're smooth. They're not very up and down. They're very smooth. And the bigger the number, like 200 EMA, the more smooth it is. But right now, we are still below the 200 EMA. I think this price might go lower. That would be, now, why is it so important we talk about these? Because we needed to get to this. This is the first thing I need you to know that is actually going to be really important for trading. Those SMA and EMA lines, they're cool. You can play with them. You can read Investopedia. You can learn them. But they are a piece of a bigger pie. And I just needed you to understand what are these lines so I can show you this, which is called MACD. MACD is one of the most important indicators that anybody learns. So MACD, the MACD. Now the MACD has three parts. You have the blue line, and the blue line is the MACD line. Okay, that's the MACD line is blue line. What is that line? What are the mathematics? It's the 26 EMA minus the 12 EMA. Now you don't have to know that math, but I'd like you to understand what an EMA is. It's a line. It's a line where the recent days are weighted more heavily than the previous days. Does that matter? No. But that's what that blue line is. And then you need to know the orange line. The orange line is the 9-day EMA of the MACD line. Again, I don't care if you know what this is. Here's what you need to know. When the MACD line crosses above the orange signal line, the indication is buy. So let's look at this. When the blue line crosses above the orange line, the signal is buy. Would this, let's go back in time a little. We're on a daily, that's fine. Let's start over. Blue line crosses above, you know, right here. Would this have been a good place to buy? Yeah, it would have. You would have made some money if you sold, if you got out at the right time. Blue line crosses above here. Would this have been a good place to buy? Yes, very. Blue line crosses above the orange line here. Would this have been a good time to buy? Price went down a little and then shot up. Yes, it would have been a very good time. Blue line crosses above the orange line here. Would this have been a good time to buy? Yes. I mean, you get the point? Like, it pretty much works. That's the first thing we do with the MACD indicator. The second thing is the blue line crosses below. When the MACD blue line crosses below the orange signal line, it means sell. So blue line crosses above, buy. Would it have been a good idea when the blue line crosses below to sell? Should we have sold here? Yes. And had we let it run, we would have sold here. Now, blue line, if you want to do every single indication, like these indications all kind of work together. This is just one indication. Remember, I said you need 3 reasons to take a trade. This is one reason. So you would have maybe bought back here and you'd make this tiny increase and you sell and you buy and you sell and you buy. The problem with these lines is they give you a lot of, they're not false readings, there's just a lot of them. Some of them are really good readings. You know, like you can make a ton of money looking at this stuff. If you hear blue line crosses above. So if you bought here and then blue line crosses below here, I mean, talk about a great trade. That trade right here, you would have made, you can go to your price range to see how much you would have made. So you bought here, you sold here. That is, 186%. You would have bought at $40 around there and sold at $147. 186%. And that's all you were doing and nothing else was watching this MACD blue line and orange line crossover. But the thing is, in the middle of this, you see there are like little cross, back up, little cross, back up, little cross, little cross. And so it's tricky because it's like saying if you catch the perfect crosses, and these are kind of the perfect crosses are big. You know, it crosses and then these lines immediately have some space between them. Here's the third thing about MACD, and this is even more important. You see where the lines have some space between them, like right here? Look at these bars. These bars, and this is called a histogram. This histogram is a visual representation of the distance between the blue line and the orange line. So when the blue line and the orange line are very, very close together, like here, you see the histogram is very low. When the blue line and the orange line are separated, then the histogram gets big. Does that much make sense, how the histogram works?
Yeah.
Okay. Now, here's the other thing you can do that's super valuable. Let's go to the MACD, and for a second, I want to turn off the MACD line and the signal line. So all I have is these histograms, nothing else. And you're going to see a lot about this if you start to study trading. And this is called divergences. Divergences are incredibly powerful. So let me find a divergence here. Let me find a good one though. Seeing too many divergences here. There's just so little trading volume on this right now.
David, by the way,
Yeah.
we can't really, I'm trying to add Golden Cross, EMA, and those lines that you mentioned, but it doesn't allow me to add more than 3.
Yes, you have the free version. You can't add more than 3. So you might have to turn them off or delete them to add others and just turn them back on when you want to use them.
Okay.
Find a good divergence. Problem is this didn't go up recently. Okay, here's a divergence. No, that's not a great example. Okay, here's a divergence. So a divergence, and there's a couple kinds, but I'm only going to teach you today the two kind of the big kinds. Let me get rid of this. A divergence, so remember MACD, M-A-C-D, moving average convergence divergence. When the orange line and the blue line come close to each other, that's called a convergence. When they separate, that's a divergence, right? That you should know that English. Now, what we're looking for in a divergence is the histogram having one direction. So the line is going down here. We're making lower lows. But at the same time, what's happening to the price? And it has to be the same time. So here, measure from the bottom, we have the price. We go here, well, we can measure it. So we have the price is going up while the histogram is going down. What does this histogram actually tell us? What does this represent? This is momentum. Momentum can be described as how fast the train is moving. So if this asset is a train, is there a ton of people getting on the train, buying tickets, throwing money, and the train is going super fast? If there's lots of momentum, like there was over here, like over here, obviously there was a ton of momentum. What happens? The price shoots up, right? That's what happens when you have lots of momentum. Here, what's going on? The momentum is slowing down. So the train is slowing down, but the price is still going up. So what's about to happen? The price is about to crash. We're always going to look for these divergences because these are going to tell us what is going to happen in the future. And that's what's so powerful about them. Most indicators tell us what happened in the past. Here we have like price is going, momentum is going up, but at the same time, price is going down. I would probably get in here, and what happened? Price went up, you know, and then down a little, and then back up. And you would have made some money if you got in here and when it went up to here. You know, that's 6 $6 to $10. It doesn't look very big on the chart, but that's a very significant. If you were able to get in here and sell here, that's 39%. That's 40%. I mean, do you know how hard it is to make 40% on the stock market? The best market managers only make, you know, the average is like 10% to 12% per year. If you could make 40% on a trade, that's huge. You know, so even though it doesn't look that big in terms of how big it is on my screen, it's a huge trade. You know, these divergences are really important. I came up with one example that I wanted to show you guys, which was crypto, because that's what I'm looking at. But I thought it was a really nice way it came together. Matic, it was on the 1 hour. Okay, so here's what I was looking at for Matic. So you can see the first thing I did was I created my S&R levels and I labeled them. And I often do turn off the 4 hour. How do you turn them off? On the right side of your screen, on the bottom, there's what looks like, you know, 4 squares. That is your object tree. And what I do, and this has everything in it, everything, you know, if you press the ellipse, you get this one, and you can, if you wanted to hide it, you could, or you could delete it, or you could lock it. My brushes, you see anywhere there's little circles, that means it's highlighted. But what I usually do is, like, for my weekly, I put them all in this folder. You create folders up here on this folder icon. And if I wanted to turn off my 4 hours, I would just hide them all. But they're still there, and that's really useful. I want to have them, I just don't want to see them right now. So here's what I was looking at. I was watching the price, it goes down, it goes up, and I saw a W. Now, I don't draw W's anymore the way I'm showing you how to draw them. I did that for over a year, right? Price goes down, price goes up, price goes down, price goes up, and I would draw it the way I told you with this W. Let's make that blue so you can see it more easily. And I would look, you know, for the confirmation line. And I would say, okay, it confirmed right where I put that circle, right? And that's where I would have bought. But these days, instead of drawing the actual W and this actual line, and again, I did that for years. What I'm doing these days is I just draw these like bottoms, you know, because this is down, up, down. Down, up, down. It's the same as a W. So you have this W. Now, at the same time, and this W is at a really important level. So we're at a weekly level. So already I'm watching this because we're at an important weekly level that I know has been respected before. So something I believe is going to happen when we get to this point, this level. We also have this nice W. You know, it's not beautiful, but it's okay. So I have this W, it's coming down to the level, and I want to know what's going to happen. So I turn on MACD. Now with MACD, let's say I want the signal line and the MACD line on so I can see what's going on. And I'm watching the crosses. So I see there's a cross here. You know, there's a cross here. Let me make this a little bigger. You can see the blue MACD line crosses above the orange signal line right here. So that might have been a good place to make a buy. Right here. Would that have been a good place to make a buy? Sure. Now, I wouldn't have, because I want this W to confirm. That's probably more important to me, but it's already something that shows me that there's a buy going on. And then the blue line and the orange line are separating a lot. That's a pretty good sign. And here, the blue line crosses below. Would this have been a good time to sell? I would have made a little profit, but I mean, not much. That's why I don't just look at these indicators. What's much more powerful is looking at the histogram, just the histogram. So here's what I was looking at. I have a W. The W is looking good. I draw a line on price. For bullish, you tend to draw lines on the bottom. So bullish means going up. Here, the histogram is going up. It doesn't matter if it's price or indicator. It's going up, so I drew a line on the bottom. But what's going on with price? Bearish, it's going down. Move that to the front. The price is going down while the histogram is going up. So what's happening? Let's just think about the market. You have a train that's moving faster and faster and faster. People are shoveling money. So there's money going into this asset. There's more people buying it. There's just more momentum. But what's happening to the price? The price is going down. Why? Because a lot of people are scared and they're selling. So the price is going down, but to me, this is a wonderful indication. Now, at this moment where the W crosses and confirms, that's where I would probably buy. Now, you could have bought before then, and you would have made a nice profit. It's a 3-to-1 right here. So you could have made, you put in risk $100, you make 300. Risk 20, you make 60. You know, like, so you could have put a trade in there. I probably would have put a trade, let's see, why did I say I'd put a trade in here? The W comes down. I think because this is the moment right here where this divergence for me confirmed. The divergence confirmed here because you had the price going up and it hit this second histogram while the price was still making lower lows. So I would have probably bought in right here. And then when the W confirmed, I'd be even more sure, maybe I'd add money. And then from my buy price to my sell price, how do I know when to sell? Right here, we're at a weekly level. That's all it is. Now, I wouldn't probably sell it all. I'd sell half. You know, if you want to sell it all, you can. This would have been an almost 10% profit. You know, 10% rise. So if you're talking about the amount of profit, let's say like Anais said, I'm risking $20. Let's talk about that trade. I got in here and I sold up here. I was risking $20. How much did I make? 9.62 times 20. So something like $200. You made $200 by risking $20 because you looked for 3 indications. Number 1, price was coming to a weekly level. Number 2, you had a W that was coming in and confirming. Number 3, you had a bullish divergence where you had price going down and an indicator, the MACD, going up. You take the trade, you make $200. Rinse, repeat. You know, it's like that. That's what trading is. You wait for the price to come to one of your levels. You don't know what's going to happen at that level, so you're watching an indicator like MACD, and you're watching divergences. Now, what if there was no divergence? I wouldn't do anything because you want 3 indicators.
David,
You know, yeah.
divergences, do they work in the opposite way as well?
Oh, definitely. Look right here. You have momentum slowing down. But you have price, oh, sorry, it's bullish, so it should be below. So I have price going up while momentum is going down. Now, this isn't a perfect example because it, by the time momentum went all the way down, price had already fallen. But if you were watching here, you're watching price go up, momentum go down, get out. Because the train is slowing down, but the price is still going up. It almost always works, in fact. Now, the challenge is right now we're doing this in hindsight. Momentum is going down while price is going up. The moment that momentum confirms to me that it's going down, so maybe over here or so, sell and get out. Because momentum is going down, and what happened? It confirmed even more. Momentum went down even farther, while price is still pretty much going up. I mean, sometimes it'll be okay, but I would get out of there. And eventually it's going to crash. You might have little ups and downs, but momentum, if the train's slowing down, that means there's less and less money. Price can't go up. Not forever. The markets can be manipulated, and they certainly are. But this pretty much always works. So anytime you can the thing about trading is you have to have an idea and you have to what's called back test. So let's look at a different stock. Let's look at Kronos. That's the other marijuana stock. And let's see if this seems to work for us. Let's go back. So back testing means you just go back in history and take a look, see if this seems to be working. Every stock and every asset is different. So let's see, when we have momentum going down, is price also going down? But we want a divergence. Here you have momentum going down and price going down. We want a time when they're opposite directions. Okay, here it looks like we have momentum. Momentum seems to be going up, and price seems to be going down. Now, I would guess that price is then going to increase. And it did a little bit. We have, here was a big move. Was there an indication if we were watching? Momentum was going up. No, price was going up. Let's see. Momentum going up. This looks like one. Momentum is going up and still up. Price at the same time is falling down. This would have been a great time to buy. You could have bought at $8.21 and sold at $9. Now, how would you know when to get out? Either you have an S&R level or you look for a divergence in the other direction. So look for momentum going down while price is still going up. Here price was kind of, let's see, still going down a little. No, that wouldn't have told you to get out. But let's see, here we had momentum going up. No, here we had momentum going down. How about this? Momentum going up, price going up. No, that wouldn't have told you. Momentum going up. How about this? Momentum is going up, price is going down. If you bought here at 697, price would have gone up. I mean, generally, it's very powerful to be able to, the reason is it doesn't work all the time, but it's pretty hard to predict the future, you know, and that's what we're trying to do with these divergences. Now, what's interesting, just like Min Soo said, you can draw W's and M's on anything. You can do this on anything too, divergences. So if we put the MACD and the signal line back on, it works the same way, that if you have the MACD and the signal line, you know, going up while price is going down, like this, the histogram told you here you have, let's find a time when it was going up, but price was going down. Up. Up and going up. See, this is why I like histogram a lot more, because if you were just following the signal lines, this just tells you to when to get in and out. But if you're looking at the histogram, this shows you a trend going down while price is still clearly going up. And this would have been a very clear indication. Momentum is slowing down so much, but the price is still going up, it's going to crash. And it absolutely did. And it was a huge crash. You know, from $15 all the way down to like $8.50. You know, if you were shorting that, you could have made a lot of money. So I prefer to use the histogram. Let's see, could we have predicted this big move up? What did we have here? Any indication? We have price going down. So we have momentum going up while price is going down. And when it confirmed on this histogram right here is when I would have bought, and you would have bought at 670 and you could have sold as high as 12. That's 200%, it's 100% increase. It's like, and you predicting the future here. It's so powerful and it's so important. You know, we can't really move on until we've learned a little about what a divergence is, because we're going to be using them all the time. So divergence is the bullish, bearish divergence. I'm not going to talk about the hidden divergence right now. We don't need to know that. Yeah. That's weird. So what I'd like you to do for homework, I want you now to find a trade. I don't think you should take the trade, but I want you to find a trade. So like Min Soo found the W's with the support level, great. I want you to add divergences, and I want you to use the take profit and stop loss. So I want you to actually determine, you know, so if you found a trade based on your, now this might not be a good trade, it's based on divergence, not W's and M's. And I think W's and M's are also very important, but I want you to use this long position tool to decide what would your stop loss be. It would be below your previous low. So what was my previous low was about here. I would have put my stop loss a little below that, so around there. And where would my take profit be? Let's say, if, you know, it would be up here, wherever it is based on your level. And I want you to have this red and green in your chart because you need it. You need these numbers to figure out the math of how much you need to buy. I want that. The other thing I recommend you can try is something called Wu Manchu. So I said I'm using Market Cipher A and B, and those I said you need to pay for, which you do, but somebody made a free version. It's not perfect. It's pretty good. It's called Wu Manchu, this Cipher A and Cipher B plus divergences. If you look at cipher B plus divergences, this is what it looks like. These blue lines pretty much are the MACD. So what's going on right now? You know, it has this little green line here that's printed. It's showing you there's a divergence going on right now on Chronos. The momentum is going up, the price is going down. The price has already corrected up a little bit, but there might be more going on. Maybe I should take a look at Chronos later. Let me see what the MACD shows. MACD. So, MACD showing us. Blue line crossing above, that would be a buy. So you had a buy back here at 631, and we're still trading in this range. It's still pretty much a buy. These haven't crossed below yet. Momentum is moving upwards while price is moving downwards. Let's keep watching Chronos for next week. The prediction, this is the hourly. What's going on the daily? On the daily, no, we already had a sell signal on the daily. You know, so let's keep watching Chronos for next week and see what happens. But you can play around with that indicator if you want. For now, work on making the S&R levels, the daily, weekly, 4-hour. Work on making the trend lines. If you want, you can try an SMA or an EMA, not necessary. But if you want that 50 and 200, so you get the death cross and the golden cross, that's a pretty big thing that people look at. And then try with the MACD. And I would get rid of the signal line and the MACD line, but take a look at them, see where they cross, see if it would have been good buys and sells, and try to find a divergence and a W that, I mean, it's a lot of stuff, you know, but we are very close. Next week, we'll add Fibonacci levels. And at that point, we're pretty much at trading point. You know, there's a million other things, and we'll keep studying stuff. But once we're at that point, that's all you should need to be able to start to do trades and make money. But you gotta wait. The biggest part of trading is patience. That's the hardest part. It's why people lose all their money, because they want to make a trade. It's exciting to make a trade. It feels good to make a trade. It's like a rat pushing the dopamine button. It feels good to press buy and sell. And that's very dangerous. You know, 95% of traders lose money, and it's not because they don't know how to trade. It's because it's too exciting and they're impatient. So that's the key thing. There's another bus in 10 minutes. If you miss this trade, don't worry about it. There's like 10,000 stocks and 4,000 coins. There's things going up and things going down all the time. You're always going to have opportunities. Okay, any questions?
Can we have your Word file once again in the group chat?
Sure. It's not very clean right now, but like it's got my notes and stuff all over it, but actually, let me clean it up just a tiny bit, just a second. Uh-huh. Sorry, just a second. Here we are. Okay. Cool. Got it? Did it go through?
What?
Yeah, I just open it.
Yeah, okay. Okay, cool. Well then, just message me if you have any questions, and otherwise I will see you guys next week.
Thank you.
Bye.
Bye, guys.